Hey guys, Mike here. Hope you're doing well. Doing a quick video. I had a lot of you ask me this very common question, so I wanted to do a quick 10 or so minute video on this topic, which is how do normal bank investments work? Mike, I got a little bit of money saved up, and you know, if I go to the bank, what do I tell them? How do bank investments work? All that fun stuff. So again, I don't provide any advice. I'm just providing education on sort of the options and what you need to know, and then important takeaways. Again, my name is Mike. If you don't know who I am, I have a Facebook page called The Financial Mechanic and a YouTube channel called The Financial Mechanic. I would really appreciate your support if you guys can click like, subscribe on my YouTube channel. I'm posting all my content through YouTube, so if you guys can subscribe there, appreciate your support. Okay, let's get into it. So, stock, bonds, mutual funds are your most common asset class when it comes to financial institutions. So, let's say you've got a little bit of money and you go to the financial planner or advisor and say, hey, what should I do? So, the most common option is this whole topic of a mutual fund. So, you might have heard about what mutual funds are. Many of you maybe already know how these work, but I get this question a lot, so I want to explain it. So, what is a mutual fund? So, first of all, a mutual fund is basically a compilation of a bunch of people's money. So, person A, person B, person C, all the way basically hundreds and hundreds of people, again, depending on how big the fund is. The whole point of this is everyone has a small chunk to sort of invest into the fund, and then this whole pool gets sort of collected into one giant pool called a mutual fund. The question is, what is in the mutual fund? And every bank and financial institution has all bunch of different types of mutual funds. Again, the most common, sort of two most common asset classes that they put into these mutual funds are stocks and bonds. That in itself has a whole bunch of different things that you can sort of have exposure to. So you can have US stocks, Canadian stocks, US government bonds, Canadian government bonds. So again, there's many different options, but the most common sort of form of financial bank investment is this idea of a mutual fund. And a mutual fund most commonly has bonds and or stocks and other things as well, but those are the most common. You have other things like fixed income treasury bills and GICs and stuff like that. So that's the most common sort of asset classes in a mutual fund. Now, in terms of understanding how much stocks and bonds you should have your financial planners help you out with that. I'm not providing any advice on that. I'm explaining how a mutual fund works. So again, the whole idea is your risk tolerance and what kind of exposure you want and so forth. But what I do want to comment on regarding mutual funds is the different types of mutual funds. So it's interesting because I actually didn't know about this until a couple of years ago, and the whole financial institution industry had a bit of a change. So, what is that change? So, I don't know exactly what year it was, but it was about 2 or 3 years ago where basically banks, up until this point, did not have to have as much transparency regarding management fees and expenses charged just to run those funds, which is interesting because you would think that you as the investor, the individual should know all of the fees that are charged. So of course they disclosed some of them, but they weren't as transparent as sort of people were hoping to. So 2 3 years ago that legislation changed, and now basically on every sort of mutual fund statement that you look at, so if you go to any bank, credit union, wherever you sort of bank at, and if you're at a position where you're looking at options, they have to tell you what fees they charge. The most common term that all of these fees come into is something called a management expense ratio, which is an MER. So management expense ratio is sort of a compilation of the total fees charged for these funds. Now, fees are very important to understand, okay? And I think that some of the banks, to be honest, overcomplicate how the fee structure work. I'll do my best to simplify it. But what you need to know about is this, is fees matter. I'm not saying that fees are bad. It depends. If the financial institution, the managers of the funds are doing a great job, they should be compensated. However, I'll just kind of give you some examples. So um, I did a quick calculation on my computer here. I'll look at it in a second. So let's say you have two funds. You have Fund A, Fund B, and Fund A pays 7% and Fund B pays 7%. Okay, so look at what happens. So if you were to invest $100,000 in both funds, okay, 7% total return. However, this fund here, Fund A, pays only sorry not pays, well, 7% return, but the fees are only 0.5%. So 6.5% is what you take home. Okay, 7 less the 0.5% gives you 6.5. And this fund here also makes 7%, but before fees, and after fees only makes 4%. So what you're seeing now is, let's say you invested the same $100,000 in two different funds. Okay, both making 7% total, but before fees. After fees, this one makes 6.5%, and this one here makes 4%. So if you were to actually do a quick future value formula, which is basically taking what happens today and projecting it out to the future, Fund A would make, let me see here, 324,000. So again, 100,000 over 30 years invested at 7% total return, but only you keep 4 because the fund takes 3% management fees. So 324,000 and change. And the fund B that would return 6.5% would give you, let me see here, 661,400 and change. So basically double. So again, one fund that again, both 7%, one takes 3% off, one takes 0.5%. So basically 324,000 and change versus 661,000 and change. So that's massive. So the exact same fund, but the fees are just 2.5% different. You have one that charges 3%, one that charges 2.5%. So that in itself shows you the power. And again, this assumes compounded and the return is the same over 30 years, which again, we all know that's not, a realistic assumption, but you have to go with some kind of numbers to illustrate. So basically it's doubled. So, and all that's changed is a 2.5% change in the fees that are charged in the fund. So what I urge you to, for those of you that are in a position and you're going to the financial planners and institutions, just understand how fees work. So first of all, that the whole fee structure is typically called the management expense ratio. You may see different things like administration fee, a management fee. Then there's things like trailing commission. So, they call it all different types of things. But at the end of the day, it's a percentage and it's a fee. Just know what you are getting into. I'll give you a very quick example. I won't say which institution, but when I started to sort of look at my options, looking at investments, I went to the bank and sort of said, hey, this is before I sort of knew about, how important fees are and stuff like that. Hey, I've got this chunk of money. What should I do with it? And we sort of talked about it, and based on my risk tolerance and so on, we put it into a fund. And that fund charged over 2.5% of fees. You just kind of trust the financial planner, and you sort of say, yeah, they know what's best for sort of my investment goals and stuff like that. But 2.5% fees on a fund that grosses 4%, I'm only keeping 1.5%, right? So then I started doing some education. I'm like, holy smokes, so fees matter. And when you start digging into this, you'll see a lot of different research and stuff that talks about how important fees are, because over the long term, when you compound the growth, especially when you reinvest all the interest, dividends, all this money that the fund makes, it makes a huge difference. Just like I said, it's about half, and if you actually put larger numbers, that's just 2.5% difference. But if you start, some funds charge 3 to 4%. Which is crazy. It's crazy if the fund is doing very well. Then it's supported. But the problem is a lot of these funds don't do very well, and then the fees are very high, and then you, the investor, keep not much. You keep the difference. So one thing that I want you guys to look at is this whole idea of index funds. Okay. So index funds are fairly new. They've been created about 10, 15 years ago. There's many different types of index funds. Index funds are basically like this. So they are a kind of like a mutual fund, which basically, a bunch of investors buy units in this fund. But what this fund does is it buys a position in whatever exposure you're looking at. So you can get an index fund in government bonds. You can get an index fund in US stocks. So the one that tracks the S&P. You can get one that tracks the Canadian stocks, such as TSX. Why do index funds matter? Index funds matter because typically index funds have very, very low fees. And why is that important? It's very important because, for the same example I just explained, over the long term, if you have two funds, and they have exposure to the same thing. Let's say Canadian stocks, Canadian stocks. One fund has 0.5% or 0.1%. Some of these index funds have 0.1% or even less of fees because they don't have managers, and they sort of return everything back to the investor. Fees are very low, which is great. The whole point of index funds is so that you're not paying huge fees for having managers sort of look over this, because they're buying the market. And if the market does well, then the fund goes up. If it doesn't go up, then if it goes down, then of course the fund will lose money. But the point of index funds is that they charge very, very low fees so that you, the investor, keep sort of most of the return. So if a fund makes 7%, and a lot of index funds, let's say, have a 0.1% management fee, you keep 6.9%, rather than most mutual funds have an average of 2.5% to 3% fees, which again cuts your 7% down right away to 4.5%, whatever it is. So, look into index funds. You can get an index fund in pretty much any type of bank asset. So whether it's government bonds, stocks, emerging markets, again, just do your financial education, talk to your planners. Just say, hey, I've heard about this index fund idea. Can we look at options where we can, see if index funds fit in my portfolio? And so I urge you guys to look into that. Again, I hope you guys found this helpful. So key takeaways are: the most common type of bank investment is a mutual fund, and in that mutual fund you have stocks, bonds, are as the most common asset classes. And then of course you have this whole idea of an index fund, which is something I think all of you should look into. Anyway, again, my name is Mike. This is The Financial Mechanic. If you guys can please click like, follow my page on Facebook. I'm throwing all of my content on YouTube. If you guys can click subscribe on there, follow what I'm doing. If you have questions, if you have any comments, appreciate your feedback, appreciate your support. Hope all of you have a great rest of your Sunday. Otherwise, we'll see you on the next video.